You are listening to The Vocal Technologist. Spoken Tech for your ears.
Welcome. Welcome. Okay, we are digging into some fascinating stuff today. You send over this research, and honestly, the speed at which finance is evolving, it's just mind-blowing.
It really is. We're not just talking about institutions maybe getting into digital assets anymore. It feels like the infrastructure itself is becoming digital, like fundamentally.
Exactly. It's no longer if, it's how fast and how deep. So yeah, maybe this is the vocal technologist digging into the absolute core of it today.
Let's do it. The mission, I think, is to connect the dots between three huge trends colliding right now. You've got TradFi finally jumping in properly, stablecoins everywhere, and this explosion in AI agents needing to pay for things.
Right. It's not just market noise or price speculation. This feels like the actual blueprint being laid down. Systemic change.
That's the word, systemic. So where do we start? Wall Street seems like the obvious place, the big money.
Yeah, let's start there. TradFi committing, and you have to begin with JP Morgan, right?
Yeah.
When they make a move like this, everyone else kind of has to pay attention.
Absolutely. And it's the depth of their move that's striking. By the end of 2025, they're planning to let institutional clients use Bitcoin and Ethereum as collateral for loans.
Okay, hang on. Not just experimenting. Using BTC and ETH like treasury bonds or stocks for actual institutional loans.
It's exactly it. Positioning them right alongside the traditional blue chip stuff in their credit system, basically saying these are now prime collateral assets.
Wow. Okay, the leverage implications are huge. But, I mean, how does a legacy bank built on, like, T+2 settlement even handle that? What are the operational headaches?
Oh, they're significant. Huge. Think about it. Their whole system is built around closing the books daily. Now they're dealing with assets that trade 24/7 nonstop and can swing wildly in price.
Right.
So they need real-time everything. Real-time volatility tracking, dynamic margin calls, all plugged into systems that were never designed for that kind of speed or constant risk adjustment.
When I run Formula One on cobblestones.
Exactly. That's a perfect analogy. The infrastructure just isn't built for it yet.
And it's not just JPM. The partnerships we're seeing, they confirm this is about scale, right? Like Citi and Coinbase teaming up.
Right, focusing initially on making it easier to get fiat money in and out, those on-off ramps, but for institutions?
And Citi's reach is massive. What is like 90% of the big e-commerce companies?
Yep, 90% of the top e-com firms, plus 15 of the 20 biggest global fintechs. So if they build robust 147 fiat to stablecoin pipelines, well, you can imagine the liquidity that could flow in nonstop.
And then there's MasterCard. They're not just using the rails. They're trying to buy the plumbing itself, right, with this potential zero-hash acquisition.
Up to $2 billion.
Yeah, that signals a huge strategic move. It's way beyond just processing stablecoin payments. They want the underlying API infrastructure, the ability to offer a whole suite of digital asset services.
Okay, but maybe the most jarring sign of the times is Western Union. Western Union on Solana, that feels unexpected. Like a steam train company announcing they're building Hyperloops. It does, doesn't it? This, 175-year-old institution planning to launch its own USD-backed stablecoin, USDPT, on Solana. Probably first half of 2026.
And the goal is?
To let their 100 million customers send money internationally without dealing with local currency conversions or the old, slow correspondent banking mess. It's a massive signal that the old ways of moving money are really on their way out.
Okay, so the old world is plugging in, adapting, buying the infrastructure, Wall Street using assets as collateral, payment giants buying the tech, legacy players upgrading to blockchain rails. But then there's this entirely new thing being built in parallel.
The robot economy.
Yeah. Which brings us to probably the most technically fascinating piece here. The BY-402 protocol, what is that exactly?
Okay, so BY-402. It's really fundamental for what people are calling agentic commerce. It's essentially a way for machines, like AI agents, to pay each other instantly and without needing to trust each other. It actually brings back an old internet code.
HTTP 402, payment required. I remember that. It never really took off, did it?
It didn't, but now it's being repurposed. It enforces payment on the spot using signed stablecoin microtransactions, usually USDC. Think tiny instant payments between machines.
Okay, so AI agents can just pay other AIs for data? Or hire them to do tasks without a human clicking, oh, crazy.
Precisely. Autonomous payments for API calls, for compute resources, for specific services rendered by another agent. And the uptake is just vertical. The material mentioned a 10,780% surge in activity in 1 month.
10,000%. That sounds almost made up. Is that sustainable?
Well, it shows the demand is there, right? It lines up with some pretty bold predictions, too, like a 16-Zibble forecasting that autonomous AI transactions could hit $30 trillion by 2030.
Whoa, okay, pause. $30 trillion for robots paying robots? That sounds like science fiction. How do they even get to a number like that?
It's based on the sheer frequency and scale of machine-to-machine interactions. If you have billions of AI agents constantly querying each other, needing specialized data, needing processing power, and every little interaction requires a tiny subset payment.
It adds up incredibly fast because there are just so many transactions happening all the time.
Exactly. It's the volume, the multiplicity of microtransactions, not necessarily huge payment sizes.
Got it. And this whole agent commerce thing, it's not just by 402 floating out there, right?
Yeah.
There's a stack involved.
Correct. You need a few pieces. First, there's A2A, that's the communication language, how agents talk to each other. Then AP2, think of that as the automated invoice, detailing what's being paid for, the terms, auditability. And then by 402 actually handles the verified payment on the blockchain.
So talk, agree on terms, pay, all automated.
All automated, zero friction. And crucially, developers are getting easier ways to use this.
Oh, yeah. How so?
Well, there's an open source library now. Developers can run their own by 402 payment facilitator, basically self-host the payment part right in their app. They don't need to rely on a big centralized platform.
Nice. More decentralized.
Yeah.
And it works on the major chains.
Yeah, the starter kit already supports Base, Polygon, Avalanche, Solana, the main ones where you'd expect this kind of high throughput activity.
Okay, so if AI agents start firing off trillions of these microtransactions using stablecoins, it raises a huge question. Who gets the interest, the yield, from all that digital cash sitting around? Which leads us to this idea of the stablecoin tax.
This is a really critical kind of underlying tension in the space right now. Basically, major chains Solana, Base, Arbitrum, BSC are hosting billions of dollars in stablecoins like USDC and USDT.
Right.
But the yield generated from the real-world reserves backing those stablecoins, it goes mostly to the issuers, like Circle and Tether. We're talking over $1.1 billion a year leaking out of these ecosystems.
$1.1 billion? That's more than the fee revenue those chains make, isn't it? How does that tax actually work? It's not a fee per transaction.
No, it's not a direct fee. It's about the reserves. For every USDC, Circle holds a dollar somewhere, often in safe stuff like U.S. Treasuries. They earn interest on that dollar. The blockchain provides the rails, the settlement, the security, but Circle keeps the interest.
So the chain does the work. The issuer gets the profit from the underlying money.
Pretty much. And the Solana example really highlights it. Around $15 billion in stablecoins on Solana, generating maybe $500 million a year for Circle.
And the kicker. Some of that money Circle makes, generated on Solana, actually ends up funding competitors.
That's the really sharp end of it. Through revenue sharing or investments, some of that yield helps fund Coinbase's projects, including Base, which competes directly with Solana for users and developers.
Ouch. Okay, so naturally, the L1 developers look at this and think, hey, we should capture that value ourselves.
Right.
Launch our own native stablecoin.
Exactly. Redirect that yield back into the ecosystem, maybe buy back the native token, boost staking rewards, whatever.
But that creates a dilemma, doesn't it? This credible neutrality thing you mentioned.
It's a huge dilemma. Blockchains pitch themselves as these neutral platforms, just enforcing rules fairly for everyone, like a digital property rights system.
Right, impartial referees.
Exactly. But if the layer one itself starts issuing its own stablecoin and managing the yield for its own benefit, does it start looking less like a neutral utility and more like, well, a fintech company trying to maximize its own profits?
Yeah, you risk undermining that core trust, that promise of neutrality. It's a tough balancing act. Short-term gain versus long-term identity and trust.
A massive trade-off. And how different chains navigate this will be really important for their long-term health.
And while this internal debate is happening, governments aren't just sitting idle. Japan's moving ahead with regulated stablecoins.
Yeah, really significantly. They've launched the first legally recognized yen-backed stablecoin, JPYC, fully compliant with their new Payment Services Act. And they're not thinking small.
How big?
Targeting 10 trillion yen in circulation within 3 years. That's, what, around $65 billion US? It shows serious, large-scale regulated adoption is coming, and not just focused on the US dollar.
Okay, fascinating. Let's shift back to the pure mechanics, the plumbing needed to handle all this volume, whether it's big institutional flows or tiny robot payments.
Yeah.
How is the actual spending of this digital money evolving?
It's getting much smoother. We're seeing more stablecoin-linked debit cards.
Yep.
You hold USDC or USDT, swipe the card at any normal Visa or MasterCard terminal, and it converts to fiat instantly at the point of sale.
So seamless for the user.
Yeah.
And benefits for the merchant, too.
Potentially huge ones.
Hmm.
This setup could basically eliminate those 1-2% early payment discount fees merchants sometimes pay to get their cash faster. Settlement becomes almost instant, which is great for their cash flow, their capital velocity.
Makes sense. And the underlying networks need to handle this. You mentioned Base earlier. Their scaling plans sound pretty ambitious.
They really are. They're aiming to double their gas limit, basically their transaction capacity, by the end of 2025, going from 75 to 150 million gas per second. And then pushing even further, targeting maybe 400, 500 megas by early 2026. The goal is clear. Get transactions reliably under a cent and under a second, even with billions of users. They even proved they could handle 1,500 transactions per second back in June with fees under 5 cents.
That's the kind of throughput you need for mass adoption, for sure, and for things like high-frequency trading on-chain. Which brings us to those proprietary AMMs, especially on Solana.
Right. These specialized automated market makers, often run by sophisticated trading firms, have captured a huge chunk of Solana's trading volume, over 40%.
And the key is speed.
Speed and cost.
Yeah.
They can update their pricing algorithms, their curves, up to 74 times per second. That's only really feasible because Solana's transaction costs are so incredibly low.
So trying to do that on a more expensive chain like an EVM chain.
It's much harder. The cost of those constant updates would be prohibitive, and the risk of getting front run is higher. So Solana's architecture kind of enables this different, faster class of trading infrastructure.
Interesting structural difference. Okay, one last piece of infrastructure, maybe more economic infrastructure, this Lockenomics model. Velodrome, Airdrome. What's that about?
It's basically a mechanism to incentivize long-term commitment to the protocol. Users lock up their governance tokens, often for quite long periods, up to 4 years as possible, and the average lock is apparently around 3.6 years right now.
Wow, nearly 4 years. What do they get for locking up that long?
They get voting power, the ability to direct where future token emissions and protocol fees go, and they usually get a larger share of those fees themselves.
Okay, so how does that become a speculation tax on people who don't lock up?
It's about incentives and dilution. If you're just holding the token short term, hoping for a price bump, you don't get the voting power and you don't get the boosted share of fees or emissions. Those rewards are flowing to the long-term lockers, so effectively the short-term holder's stake gets diluted over time relative to the committed long-term holders. It makes pure speculation less attractive and rewards those actually invested in the protocol's long-term success.
Got it. So it engineers loyalty, basically. Okay, what a journey through the stack today if we try and pull it all together. What are the big takeaways?
I think there are two massive parallel shifts happening. First, you've got the undeniable, irreversible integration of digital assets into the core TradFi system. Bitcoin, Ethereum becoming collateral. That's fundamental.
Right, the old world absorbing the new.
And second, completely separately but related, you have the creation of this entirely new payment layer built for machines, the BI-402 protocol enabling this agentic commerce. It's a ground-up build for a future economy.
So finance is being re-engineered from both ends. Legacy systems adapting downwards, and a new machine economy building upwards.
That sums it up pretty well, and the speed is just accelerating. Understanding this stuff, getting your head around it quickly, it feels more critical than ever. This isn't niche anymore.
No kidding. It really feels like the foundation for something much bigger is being laid, which actually connects to that final kind of provocative idea from the material.
The ultimate super cycle concept.
Yeah. This idea that maybe we're not just in a tech cycle, but like an 80-year civilizational reinvention cycle, driven by AI, clean energy, bioengineering, all converging.
It's a massive idea. And the argument is, if that kind of shift towards, well, abundance is actually happening, then what we've been talking about today, the crypto stack, the blockchain, stablecoins, instant settlement,
becomes the essential nervous system, the coordination layer needed to actually manage all that potential.
Exactly. The platform you need to coordinate resources when you move beyond old scarcity models. It provides the trust, the speed, the programmability.
Makes you think about a simple USDC micropayment quite differently, doesn't it? Not just moving value, but maybe a tiny building block for whatever comes next.
Yeah.
Okay, lots to mull over there. Thanks for breaking all that down.
My pleasure. Always fascinating to track.
Absolutely. All right, thanks everyone for tuning in. We'll catch you on the next one.
Spoken Tech, for your ears.